Good afternoon. I'm Sylvia Amaro, a senior correspondent at CNBC. Welcome to this event with the Atlantic Council, where we'll be looking at decoding the latest world economic outlook. In order to do that, I have with me a very distinguished panel. I'll start by introducing Hang Tran. He is a senior fellow at the Atlantic Council Geoeconomics Center, followed by Alexis Crowe. She is the lead at the geopolitical investing practice at PwC. And last but not least, Martin Muliza, non-resident senior fellow, also at the Atlantic Council Geoeconomics Center. Thank you to all of you for being here. I'm very excited for our discussion. Before we get there, I just like to set the scene, really, because the latest World Economic Outlook painted quite a negative picture, really, as we look at the global economy. We're expecting now anemic growth for the foreseeable future. So I just would like to start our conversation by asking you, Hang, to just where are we going in terms of the global economic outlook? Because it just seems that the picture is getting more and more challenging, particularly as we watch the events unfolding over the weekend.
Right. If you look at the analysis, both in the World Economic Outlook and also in the Global Financial Stability Report, the analysis, particularly the problems facing China, is quite sober. It's really serious and difficult to resolve. However, at least to my personal understanding, there seems to be a disconnect between the really very negative analysis and the forecasts. Forecasts to me seem benign. Basically, they keep the global growth outlook unchanged from July. They revise upward the US growth and tiny downward adjustment for Chinese growth. And looking at their own analysis of both the financial system, banking system weakness in the US, coping with continued rise in bond yields. We have 5% bond, 8% mortgages. It will be doing damages to the economy. Looking at China with all the structural headwinds that they have, I fear that the forecast they have in near term for both US, China, and the global growth rate probably will be proven to be too optimistic.
So you think that the picture is actually more negative than what the World Economic Outlook
at least if you put the analysis together with the forecast, there seems to be somewhere lost in between.
Alexis, how do you feel about the latest World Economic Outlook? Do you also agree with this analysis?
Well, actually, and thank you so much for having us. So it's actually quite a common theme that we can discern with the World Economic Outlooks consistently, which is referred to actually as a hockey stick graph, where the IMF is forced to continuously downgrade its overly optimistic forecasts. One thing to note, I think, also is quite severe language on China, actually, in the property crisis. Also, a determined policy recommendation to advise China to shift away from real estate-centric GDP growth. But actually, I would also say something that was notable is Japan actually being upgraded. We forecasted last year that Japan was quite much further down the line in the recovery from the pandemic shocks to the economy. And so certainly we've seen that, which has been positive. That's consistent with our forecast. Also looking to emerging markets ex-China, forecast quite bright for some Asian emerging markets ex-China. Also for some Middle Eastern countries, particularly even still Saudi Arabia. But I would say that one thing that's been changed, as you mentioned over the weekend, is how a potentially elevated commodity price environment might actually boost some of the outlook, particularly for Latin American countries.
Very interesting. I will dive into that in just a second, but I would like to ask you, Martin, to also explain to us this, how the geopolitical scene, which is getting just more and more complex, could actually drag the global economic picture going further.
All right. So this is about decoding the World Economic Outlook, right? And you, Alexis, you just mentioned the hockey stick. Let's not forget that when we interpret the World Economic Outlook, it is an official document of the IMF, which means it had to be signed off on by the executive board, which has all the member countries represented. And there is a tendency, and I don't want to kind of exaggerate the degree that goes into negotiations between authorities and staff to kind of discuss the outlook, but there is a bit of a temptation sometimes to not be too far away from what the authorities think. It's just the nature of the dialogue. Instead, rather than kind of looking at the numbers, a lot of the story, what's actually going on, is in the discussion of risks. So one could almost say that the numbers are by nature a little bit over-optimistic, and staff compensates for that by just having a long list of downside risks. You know, a normal consumer of these reports would ask, so if they only have a little upside risk, say, on productivity and all these others, why is the forecast not a bit more kind of in the middle so that you can have a better sense of what's going to happen? Well, that's kind of the story behind it. It's not a new issue, it's been perennial, but it helps to understand what the World Economic Outlook does. Now, coming back to your question, they have been unfortunate for the second time this year. Last time they had to very quickly put in a fix because the banking crisis blew up, and it was just around the time that the outlook would hit the press. This time I think it's been too short for them to really integrate the latest developments, not only the terrible attack on Israel, but also the sharp rise in bond yields fully into the analysis. So you've seen that, for example, in the GFSR press conference. There was no presentation of the report. There was a straight Q&A going straight into the long-term interest rate question because it wasn't really that much covered. So the geopolitics look certainly worse. We, of course, don't know what's going to happen in the Middle East, but it could be a prolonged conflict. It could widen, who knows. It could have both a general, see a general increase in the risk premium. It could go to more of a dollar appreciation, which is not really covered much in the reports, by the way. And of course, it could go into commodity prices. It's just too uncertain. But if you think of developments recently in a broader context, where Russia and its allies try to kind of not widen the conflict, but make it more difficult for the United States and NATO to support Ukraine, then you could expect more things to flare up.
If I may
Of
add
course,
one
go
thing,
ahead.
one key implication for me is that commodity prices will be rising, and that will keep headline inflation number high, and that makes everyone think, even if the Fed will try to explain away that, everyone will think the Fed will keep rates higher for longer, more than people expected during the summer. So I think that change in thinking and modality, I agree with Martin, has not been fully incorporated in the wheel yet, and that's another leg to drop.
So many themes that I'm just like, where do I go next? But before actually we move on to the conversation, I just want to mention to the audience that you can ask questions to our panelists by going at askac.org. Then you select the IMF World Bank meetings and just write down your question. So I'll be able to pose that to our panelists later. So let's go back to commodities, Alexis, because there's also, of course, now this concern, and we've already seen higher oil prices off the back of the developments over the weekend. What to expect from that? Are we in for just higher oil prices for a lot longer?
Thanks so much. So firstly, I think it's important just to take a step back and look at how the price of oil moves with other commodity prices. And so we've noticed a very clear identifiable co-movement of the price of WTI with other foods and metals since 2014. And so those are very nicely correlated. If we need to look at the sources of underlying headline inflation, of course, and even passing through to core in some places, that's very clearly with an elevated oil price environment. So we have to say, what is the supply outlook and what is the demand outlook here? I would actually advise that most Western headquartered agencies consistently undershoot on the demand for oil. If we think about a country like India, where the bulk of the oil consumption increase in 2017 was driven by Modi's Make in India manufacturing campaign, you look at the consistency of statements of emerging market developing economies that they will use whatever type of commodity they can to be able to continue to drive manufacturing. The use of fiscal policy to support manufacturing during COVID. Added to that, we're all still flying around the world.
Yes.
And so there's nothing like a unit of oil to actually support transport, despite what some people are doing in the electrification of transport. So all of that is to say that structural forces are still present. Oil demand continues to rise despite the growth of renewables. So that on the demand side leads to an elevated price environment. There's another structural force which doesn't necessarily get highlighted too much in the press, which is gas to oil switching. So in the face of elevated natural gas prices, you start to move to oil for power generation, and we actually forecast that this can keep oil prices elevated, even beyond some of the geopolitical shocks that we think about. Added to that, of course, we see any potential shocks around the Eastern Mediterranean and the Persian Gulf, which of course have been coming prominently to the fore. And over the weekend, I would just ask how sticky that might be. We've got to wait to see how prolonged this conflict would be.
Of course.
I'd also just kind of throw in there as well that typically when traders look at Iran and the potential of taking Iran on or off the market, I think that moves prices in a way that's not necessarily illustrative of Iranian production capacity.
Yeah. Based off that, Martin, where do you think we go from here when you think about higher debts, bond yields? What could be the implication there?
So I think compared to where the WIO was 4 weeks ago, when it was more or less finalized, say, I would expect some slower growth going forward. I mean, some materialization of the downside risks has already happened, both geopolitically and on the interest side. As I said, I think many emerging markets especially will be hit by kind of this double whammy of higher rates and a stronger dollar. Funny enough, but as it always happens when there's a crisis or uncertainty in the world, even if there's a little bit maybe less demand for US treasuries at the moment or just too much supply, but still money flows into the US because it's the safe haven. And I mean, we've seen it quite amazingly in the Japanese exchange rate, we've seen it in the euro exchange rate, and for many emerging markets it's really a problem, I think. So I wouldn't be shocked if the outcome will be a bit less. And it's by the way, it's really very instructive to look at the long-term risks, or the long-term outlook, I should say, because that already gives us a path what to expect. And it may just be that we're a bit faster on that kind of slower growth path than we had anticipated, with all the consequences it has potentially for the capacity to fight inflation, what it means for fiscal deficits given lower revenues and so forth. So it ain't a happy picture right now. And then there's all the geopolitics in the background.
Exactly, that don't help. You mentioned US Treasuries there, and I would like to focus on the US economy for a moment, because a lot of political instability out of the United States right now. We have the election coming up, so it could be further instability going forward. And when you look at the US economy, are you worried about what this political instability could mean for fiscal policy?
Right. I'm worried more about the political instability and mayhem next year during the election. We already see that happening with the threatened closure of the US government. We see that happen with the House of Congress going for many days without a speaker, and we don't know when a new speaker will materialize. All of that add to the uncertainty and the predictability of US policy going forward. Number one, as I said, 5% bond, 8% mortgages have been there, will be there for a long time, and will really exert more downward pressure on economic activity, number one. Number two, the weakness in the regional banking system is still there. People thought that, banking crisis March 2003 is gone. No, it's not gone. The Fed saved the situation by just throwing money into it, by extend the deposit guarantee to practically own deposit, but it has a price. And banks, particularly smaller banks, will pay a big price this quarter in terms of up to 25% of their earnings will be taken away because of higher charges that the FDIC will exact from them to pay for all the rescue funds that they did. They still suffer from instability and pressure on their funding side. The GFSR had a full chapter 2, looking at banking problem in the US, but they did not really go into enough details about the funding side, which is very important. That is what brought down Silicon Valley Bank. Regional banks still suffer from pressure and the need to raise interest rate to attract funding, because otherwise a lot of deposit continue to flow out to go into money market funds now offering 5% plus yield. So I think that is, in my view, something that needs to be very closely monitored.
Absolutely. Martin, this is a bit, provoking, but I would like to ask you about the market reaction when we heard from Fitch that they were downgrading the US rating. The markets didn't pay attention to that, really. They just ignored that information. Were they wrong?
That's a good question. Probably not. We've had that debate, I don't know, 10 years back or so. There was another kind of discussion about
2013,
downgrade.
yes, 10 years ago, exactly.
So it went by, and it was okay. So what Fitch reacted to, I think, was mostly the political dysfunction that we're seeing, and that may well continue for a while. Although I would expect geopolitical events to eventually lead to some consensus in Congress about how to defend the US's interests abroad, and that implies some fiscal means. So how this is going to play out, I wouldn't be too pessimistic about a total blockade going on for too long, but there's certainly risk of another shutdown and all the politics that go about. By the way, one important discussion next year in the elections will be the expiring US tax cuts. And that's how to approach that is also going to be an important kind of medium-term uncertainty for the US, because if they're being renewed, well, then you have still the fiscal revenue problem. If they're not, well, then you have another shock on consumers and corporates. So bottom line, I think one can understand why the US gets downgraded slightly. That doesn't mean that there's any alternative around for being a safe haven. The role of the dollar is not really touched by that, but it's just been like a shot across the bow that, in my view, could have been a bit more amplified by the world economic outlook, because what the US is doing right now has huge implications for everybody else.
If I may pick up on that, on the US economy, I think what's important to look at is what are some of the underlying forces of the resilience of the US economy and its performance. And one thing I think is very clear to note, and Hung and I would have talked about this right in the wake of the crisis we did with Jason Furman together, is we forecasted that the US would recover significantly faster than Europe, given that we allowed for creative destruction to happen in the labor force. And that's exactly what happened after 2008, 2009, where creative destruction happened. Jobs were very quickly created. And so that has, I think, added to dynamism. It's added to expanding wage growth in the US, where some wages have become a living wage. This tight labor market, particularly in blue-collar services jobs, pushed real incomes up for the bottom 50th percentile of the income distribution. Added to that, even despite some of these headwinds on the financing and debt service costs, you actually have house prices continuing to rise and housing starts even continuing to rise. And so that's also a contributing factor. But I think some of the headwinds that are directly related to the political situation result from where are some of the solutions coming from. And one of those is immigration. If we look at net international migration to the United States, it's taken a significant nosedive since 2021. So I think what we need to look at is where are there policies to be able to support positive immigration. And I think that's one key headwind. The other on the financial picture here is that connected to what Hung is talking about is money market funds offering a 5% yield, is this colossus of non-bank financial institutions, which is the polite way of saying shadow banks, and the potential risk that some of these non-bank institutions have within the US economy across to the Eurozone and for global investors is very, very significant. Unfortunately, that does not feature in the Global Financial Stability Report in the way that it really prominently should do. Because if you think about where the next crisis is coming from, I think regulators are squarely focused on the shadow banks.
Yeah.
Interesting.
If I may jump
in,
I think, the chapter 2 that they have, it's only the banks, not the shadow banks, but the language is quite striking. If there's a downside, an adverse scenario, and maybe we're not too far away from such a scenario given the geopolitics, that there is a possibility that quite a number of global banks, including systemic ones, have real difficulties. So, there is a serious issue on the horizon, and when you then add the non-bank sector with that sharp rise in interest rates, who knows where these losses are going to pop up.
Yeah.
So you have potentially a pretty serious financial sector problem ahead.
That's not sounding good at all. Let's focus on the potential soft landing, because this is another big topic here, and there seems to be a bit of a discrepancy when you read the World Economic Outlook and the Global Financial Stability Report. Hang, maybe you can enlighten us here. Is the US economy on track to achieve soft landing?
We are still having the potential to engineer a soft landing.
Okay.
It depends very much on the behavior of inflation and how the Fed reacts to it. Already in the past 2 days, markets, instead of coming down after the terrible attacks in Israel over the weekend, recoup and rally. So we are now lower bond yields, higher equity markets than last Friday. And all of that was depending on the view that some Fed officials say, look, we will take the bond yields increase into consideration and we will consider them as equivalent to a rate hike. And therefore we don't need to do any rate hike. And market
It's like what they did after the banks.
Right.
Yeah.
So market participants just love that kind of language.
Yeah.
So basically, if inflation allows the Fed to basically pause and then starting to say, look, we don't need to hike anymore, and then going into 2024, prospect of a rate cuts become more visible over the horizon. There's a scenario where the U.S. economy will slow, but not to the point of a recession.
Okay.
So any slow down in growth, but above recession is defined as soft landing. So if you define soft landing that way, I think that we can have a soft landing, but depending on inflation.
Fair enough.
If not, then we have. But we have to keep in mind that soft landing for this year, meaning sliding into even slower growth in 2024. And in the real forecast, clearly in 2024, downgraded U.S., China, and so on.
Yeah.
So I think that 2024 will also be a challenging year for many major economies.
So it's not looking good. I would like actually to ask you, Alexis, feel free to add, but I just wanted to clarify from your point of view, do you think, and you've already touched on oil prices and commodities, but do you think that the latest uncertainty on the geopolitical front could actually make it harder for the US to achieve this soft landing?
Well, let's come back also just to, I think, just looking to the forecast for 2024. It's important to note, I think a lot of market participants are like overly optimistic about what are some of the implications of the concerted policy tightening that we've experienced across the globe. Regulators point out that it can take up to 2 to 3 years to transmit through the economy, and that you likely would see some sort of a financial crisis, even looking to the banks as well. So an unprecedented 95% of central banks tightened their policy between early 2021 to 2023. That number's never been seen before in economic history. Only after the oil price shocks of the 1970s did 80% of central banks actually tighten. So, now we have Brazil and Chile actually easing. Some of, the EMDE central banks actually, front-loading their rate hikes, so now coming to this other side. So I would just say that cautions the medium-term outlook, even looking beyond sort of 2024 into 2025, and I would highlight that. Prospects for the U.S. in a soft landing, also just looking to labor markets. In the World Economic Outlook, I would say that potentially overly optimistic would be a forecast for 3.9% unemployment in next year, and I would say that looks potentially a little rosy. You are seeing wage growth in the U.S., the pace of wage growth actually start to decelerate. So I would still say, when we speak to executives across sectors, you're still seeing a lot of uncertainty with regard to hiring plans as well. So I think that declining private investment in certain economies, of course, as a response to higher rates, I think is also a headwind for the medium term as well. With regard to commodity prices, there's something that the Nobel laureate Joe Stiglitz very clearly said, which is central bankers cannot control food and oil supply, right? And so that there is an element of rate increases that, there's an element of tightening that is just not going to address a tight commodity market. I would also just say there's another component here, which is the labor component of services industries is not necessarily as sensitive to rate hikes as, for example, capital-intensive industries here. So I think we've got to watch what happens with the duration of the conflict as well.
Okay.
Again, I think the fact that this is in the Eastern Med is slightly more positive than if it was, of course, across the Arabian Peninsula.
Martin, I'm hearing a lot from the IMF these days in terms of what the governments should do given all of the topics that we've just discussed. And it just seems that it's very hard for governments to get it right at this stage. The advice is watch on higher debts, watch higher interest rates, but spend to deal with climate change. We need more defense spending. How can governments get it right?
And take your cough medicine every night. These are all good suggestions, yes, but they're a little bit in conflict with each other, unfortunately, yes. It's very hard to kind of give you a general answer to that. Obviously, some countries have a bit more room, some others need to rebuild buffers a bit faster. But I think when you look at the outlook for debt, especially for China and the US, you've got to be a little bit worried about the medium-term outlook. And we just talked about it earlier, the renewal of the tax cuts, the spending pressures. So the fiscal monitor came out again with a good chart, and they had it in their debt statistics release. I think, you know, it ain't unsustainable, but it's moving in that direction. So at some point, someone's got to do something about it. But that's more of a medium-term issue. In the rest of the world, yeah, I mean, there is not much room in the emerging and developing universe to really spend big on climate, which makes it so important to raise funds to help. What it kind of is confronted with is that the willingness of many countries to provide that kind of money is not only limited by, say, the fiscal room that gets a bit smaller, even in some advanced economies, but also by the willingness because of political factors. I mean, just one example, the UK has been always a paragon of development assistance. They moved away from their 0.7 target. Others reach it, but with a bit of creative accounting.
Yeah.
So you just see how this kind of willingness to spend money on what's really needed that is being professed by the officials is being a little bit undermined by developments back home and by parliamentary procedures. So that is a worry, which makes it more important, of course, here for the international community to come up with the funding.
Yeah.
I mean, amid all the talk about how much money we should raise and the billions and trillions that need to flow into countries, what I think is really important to make this sustainable is to spend the money well and to demonstrate that it's really reaching its intended objectives. And that part of the discussion I don't see as much highlighted as how can we get to an even bigger number every year and all that. So there needs a bit of a balance, because otherwise we risk that more and more politicians in countries with fiscal issues will say, well, you know, we put in some money here, but we see it's not being used well, so let's just cut back further.
Yeah.
So it's a downward cycle. What we need is an upward cycle that's really sustainable.
A little boost.
If I may, I have a very nice catchphrase to encapsulate what Martin said.
Okay.
And that was an attack here in Marrakesh, is spending other people's money syndrome. Because the IMF or the organization say that, look, going now from now to 2035 or even 2050 to get to net zero of emission of carbon and other greenhouse gases, or to keep temperature within 1.5 degrees centigrade, blah, blah, you need from the IMF more than 2 trillion per year. And for many other organizations, between now and 2050, altogether $145 trillion will be needed to really meet these objectives. Great. Where do these things come from?
Yes.
Yeah,
One,
it's a lot.
from the public sector, like Martin said.
Yeah.
High debt, high deficit, no fiscal room, and no popular support for giving money away. And people tend to say, look, we use our public money wisely to catalyze private sector investment. Great. Everyone say, I spend $1 public money, I can leverage to $5 or $10. So altogether we have a big sum. No. Research have shown that if you spend one World Bank lending, you can catalyze at most $0.7 or 70 cents. Not 10 times more.
Yeah.
So yes, you can catalyze and get some private money in, but not by any means to the magnitude that is needed. So that is why I say things really do not add up correctly if you look at the whole range of analysis, expectation, and forecast. And that is really the problem that we have.
There's another dynamic here too, which is that there's a lot of chat about an optimistic chat, I would say through green-colored glasses, about the ways in which minerals trade as supporting the terms of trade and the future of trade, etc. But a stark reminder is the fact that by some estimates, 76% of climate finance raised just stays in the same country. Or is domesticated, and the U.S. and China are huge drivers of that. And of course, we've seen policies in the U.S. That are commensurate with that. So that is very much, you say OPM, other people's money, but it's also serious climate finance protectionism.
Yeah. I want to address protectionism in more detail in just a moment, but we got a question from the audience, which I'll read to you now. It says, Secretary Yellen said today that the U.S. isn't ruling out new sanctions on Iran after the Hamas attack in Israel. Could you discuss the potential effects of the U.S. and allies dramatically ramping up sanctions against Iran as they have done against Russia over Ukraine? Just a reminder that if anybody has further questions, you can do so by going to askac.org, select IMF, and pose your question. Alexis, do you want to take this one?
I think one thing that is notable is the extent to which some emerging market and developing countries' central banks have rotated out of dollar holdings and reserves and back into gold in the wake of the sanctions, the use of sanctions on Russia in the wake of the crisis. And so one thing to note is there a potential overuse of sanctions, and what does that have, if any, as an impact on the dollar as a reserve currency or on the euro as a reserve currency? We're not seeing that meaningfully come up in the numbers yet, but I think that's a kind of a longer-term question to be able to ask on this.
Martin.
I think Iran is already under so many sanctions from the US that the marginal impact of more, however justified, of course, would for me not be like a macro relevant point at this point. If we're talking about sanctions, there's a very interesting angle when you look at the sanctions on Russian, or not sanctions on Russian oil, but the price cap on Russian oil. Hung, your former employer just came out with a couple of charts, your successor, showing how the Russian current account surplus goes up with oil prices. Because it's being claimed that the West is not tough enough on the transport possibilities of that oil. So if we have a sanctions discussion, maybe that's the one part where we should look at a bit more closely, not necessarily Iran, although, of course, that is unrelated from the attack over the weekend. But we were talking sanctions, I think that's where there's a bit more room for creative policies.
I have a slightly differentiated view.
Go on.
In the sense that I do see a macro impact, in the sense that additional sanctions on Iran which interfere or really restrict the ability of the country to ship oil to other users, that definitely will contribute to the tightening and of the oil market and push up prices. So sanction on Iran, the knee-jerk reaction by traders would be to mark up oil prices. So that,
traders might, though, but I don't think the capacity.
It depends. It depends on how long it goes, how strictly the sanction will be applied, and so on and so forth. But the knee-jerk reaction will be higher price, translate right into headline inflation. So at least for a moment, these kind of dynamics will play out, which is not really conducive to soft landing.
Fair enough. There we go again.
By the way, just to come back on that, also what you said on the dynamism of the U.S. economy, we sometimes forget that the U.S. is, I think, again, the world's largest oil producer and has still capacity to ramp it up and benefit from it. So one could have been quite pessimistic on the oil market, even with the latest production cuts by Russia and Saudi Arabia. But it's kind of been relatively stable so far. Of course, it had some volatilities, but it's not led to a breakout beyond the $100 mark recently, despite all these pressures. So I hear you, Hung. Let's hope that commodity prices still remain within a range, although I don't want to downplay the risk.
Fair enough. I love the debate. Let me focus for a moment on protectionism. I cover the EU a lot, and I'm seeing that there's more and more measures under the idea of strategic autonomy that are ultimately about protectionism. But it seems in the latest World Economic Outlook, the phrase that the IMF has chosen to use is geoeconomic fragmentation. Is that, Martin, in simpler language, protectionism? Is that what the IMF is warning against?
Protectionism is one part of it, yeah, no doubt. but fragmentation goes further, right? It's really the lack of, not only the lack to cooperate in multilateral fora like the UN or the IMF and all that, which at the IMF we haven't seen so much yet, or the bank, but certainly at the UN there have been tensions. It's kind of a rise of trade barriers. It's just also an increased, not necessarily military, but geopolitical competition, the rush to secure resources, allies, all that together. And when you compare that to a fully open, functioning world economy, it's clear to every economist that restrictions means less optimal output. So I don't think it's only the sanctions, but Europe, since you asked about them, they're in a very tough spot.
Yes.
Because they depend so much more on China trade in terms of exports and also imports than the US does. Both the US is, as such, is a relatively closed economy. Many European economies aren't. So whatever they do there, they're going to cut themselves really in their own flesh, which makes it so difficult to come to a principled position for the EU as a whole.
Yeah, they're in a very difficult spot, hence the whole idea of de-risking rather than decoupling, right? We are approaching the end of our conversation. I'm going to pose one more question from the audience, and then I would like you to say, a positive thought or a positive conclusion from the World Economic Outlook, given that we've focused mostly on the negatives. One of the questions that we got in the meantime asks, do you have high hopes from the G20 communique and the meetings at large? I think also here one of the ideas that we can include there is where are we going in terms of multilateralism? Because we're talking about IMF reform, World Bank reform, WTO reform. Alexis, perhaps you can take this one. Where do you think we go from here? Is multilateralism still alive, really?
Well, we've been referring to it as the G18, given the two notable exceptions with regard to the latest summit. So just to come back on the protectionism question as well, there is this wider existential debate as to whether or not the entire Bretton Woods settlement is at risk. And we've seen that with the rise of the Global South. We've seen that even with regard to the voting pattern within the UN in the wake of Russia's invasion of Ukraine. We do live in a very fragmented world. On the finance side, we don't necessarily see very much fragmentation with regard to global financial capital flows, reserve currencies, etc. The dollar still holding this lion's share of reserve currency, although waning over time. Don't necessarily see that. What I would say is we are witnessing a deterioration of the credibility of countries like the United States, like the United Kingdom, like France, to be able to export democracy, just given the sharp polarization and social crises that rest within these domestic societies. So that's one thing that I noted is slightly missing, where there's a lot of talk of geoeconomic fragmentation amongst countries. But what about the polarization that is happening within societies that is actually causing a lot of these anti-trade movements to take place?
We're seeing that all over the world. It's not just indeed one domestic problem. I'm going to choose one more question from the audience. We've been getting a lot in the last couple of minutes. Hang, perhaps for you this one. For the next decoding of the World Economic Outlook, do you predict an upgrade or downgrade for the global growth? So in 6 months, where are we going to be?
If you mean the spring meeting of 2024,
yes,
I think that the discussion would be further downgrade, because all the medium-term risks that we are talking about now, the downward revision of growth expected for next year already embedded in today's forecast by the WEO, probably will come to the fore and will come into play. So the depending on the conflict in Israel, in the Middle East, the war in Ukraine will still be going on. So altogether, I would say, if I have to guess at the moment, we will be talking about further downgrades.
All right. Well, to conclude our conversation, I want to focus on the positives. Martin, looking at the latest World Economic Outlook, is there one bright spot that you would like to highlight?
Well, there's the one upside, risk on productivity. So, look, coming back, I do have a positive message. It's coming back a little bit to the story that also you, Alexis, mentioned, the support for multilateralism. Many people who come here have the expectation that with goodwill at these meetings you can achieve a lot, because everybody comes here and puts out all these messages in support of the global good. But the meetings almost, not always, but many times really disappoint, because people who come here don't have the support from their parliaments and voters back home. There's a lot of anger about giving too much attention to international issues, not just in the US, also in Europe you can see it and elsewhere, rather than on domestic preferences. Domestic inequality everywhere is poison for multilateral cooperation, because it means you give up a little bit for the greater good.
Yeah.
But the greater good is hard to observe, especially if you're unemployed or if you're kind of constrained with your budget, you can buy anything. So we kind of sometimes abstract from that when we come to these meetings. And then everybody goes home and says, well, nothing happened really.
Yeah.
Now, I put out a little piece yesterday because I see these wonderful kind of surroundings here by Morocco, all very sustainable, one has to add. They've been great hosts. And lots of people walking around in the open, chatting, a little banter here or there between different country officials. Even say, when you see Chinese officials practicing their speech later that day in front of an iPhone to see whether they really get the message across, you see there is a willingness among people to cooperate that are here.
Okay.
And while maybe we will get some agreement on MDB capital and maybe not on IMF quota, we see small victories being won. One issue, one country maybe at a time. And that this process keeps going, that these personal relationships stay in place. They were so important during the COVID years when nobody could travel, and still the whole apparatus internationally functioned. That is still a positive sign, and I hope we'll see many more of these meetings, maybe not quite as hot as here, but the spirit is still alive, I think, and I hope we can preserve it among these institutions.
Alexis, what is the bright spot you would highlight?
I'm going to highlight two countries, India and Saudi Arabia. These have been consistently forecasted by the IMF, and rightly so, and OECD and others as some of the fastest growing economies in the world. Firstly, with regard to India, I think the forecast is slightly revised upward just given stronger private consumption. So you've seen a number of strong policies coming out of the Reserve Bank of India to maintain financial stability throughout the shocks from COVID and the successive waves of the pandemic. It is not the next China. There is no next China, but certainly the country, as other Asian countries, is benefiting from the fracturing and duplication of global supply chain activities. So that's one. Saudi is a second one, where actually Managing Director Georgieva has highlighted and lauded Riyadh for the extent to which private investment is really driving non-oil-based GDP growth. We're seeing that beyond the kind of giga projects like NEOM and others, and so that's certainly a bright outlook, and both of those countries, by the way, remain non-aligned in this fragmented world.
Hans, what's your bright spot?
Bright spot is depending on your expectation. If you expect a lot breakthrough, then you will be disappointed. But for me, I expect very small thing, more or less along the line of Martin, and we were fretting that we were very much saying the same thing. But anyway, if you expect small things, small steps, then you can expect some positive step here in Marrakesh. The finalization of the optimization of the balance sheet of the World Bank and other multilateral development banks, small step, but it can free up to 100 billion over 10 years of lending. Not a big numbers, but useful. The IMF, well, redistribution of quota to raise the share of emerging market countries, probably not doable, but an overall equi-proportional raise of quota to give the IMF more permanent resources, doable. Will it be done today here or next year? No one knows. But I think that there is hope that it can be done. And last but not least, there's some small step in terms of improving the framework for sovereign debt restructuring, which we did not have time to go into. So Zambia, for example, after 3 years of waiting, hopefully by the end of our meetings here in Marrakesh, they will be able to sign an MOU with bilateral creditors to get that out of the way for their recovery.
I'm glad we managed to finish on a positive note. Thank you to all of you, Martin Molaisen, Alexis Curl, Han Tran. It was a pleasure to speak with the three of you. And thank you as well to our audience for sending questions through. We hope you enjoyed the conversation, and we also hope to see you soon. Thank you.